Hello, my name is Artūrs Breicis. I am certified tax advisor in Latvia, and our primary operations are related to transfer pricing and international tax. And in today's video, I'm going to tell you about the Latvian corporate income tax and how to build effective tax structure, effective corporate structure in order to benefit from Latvian tax, and how to create, operate, and finally exit from this structure. Okay, let's get started. First of all, about the content of the seminar, of this video, we are going to talk about, first of all, about corporate income tax, how does it work in Latvia, how the dividends are taxed, the profit, how is taxed profit and dividends, what are the so-called flow-through dividends. And the next topic is for the individual investor, if you are an individual investor from abroad, and what would be the most efficient way for you to create a corporate structure in Latvia, and what to do if there are several investors, and what are the options, how to effectively manage the corporate structure in Latvia, and finally how to exit from the structure if you decide to wind up and leave Latvia. So first topic is about the corporate income tax. How does it work in Latvia? And here is the point that Latvia has quite unique corporate income tax structure. It's quite similar to structure in Estonian tax in Estonia. And it works in a way that you are going to pay the corporate income tax only when you distribute profits. So compared to traditional corporate income tax system, when tax is payable based on the accounting profits, on the calculation of profits, and sometimes and usually you have to pay tax and without taking the dividends, and tax expense is always you're always liable to pay the tax. So in Latvian case, the tax is payable only when you take out dividends. So unless you do not distribute the profits, the dividend tax, profit tax is not payable. And this is a certain benefit, certain advantage of Latvian corporate income tax system, which is quite favorable and for also foreign investors. So how the corporate income tax works? We have here an example. First of all, there is an operating company, let's call it operating company without a name, who has a sole shareholder in Germany. So and this Latvian company has the following figures for the year: that sales 1 million, cost of goods sold 500,000, operating expenses 300,000, operating profit 200,000, and in traditional corporate income tax system, you had to pay corporate income tax out of this 200,000 euros. Right, but in case of Latvia, if in Latvian corporate income tax, you pay tax only then for the amounts you are distributing as dividends. In this case, the operating company distributes 100,000 euros, not all the profits, but just part of it as dividends. So, and the tax payable here is 25,000 euros. How is this tax calculated? It is calculated as follows. So we have a tax base, and tax base is dividends which are calculated, which are physically paid. Those 100,000 are physically paid. When we divide it by multiply 0.8. And then from this amount we apply 20% corporate income tax rate, and we get 25,000 euros in this case. Yes. So what does it mean? It means that Latvian corporate income tax rate is 20%. Sometimes there is a misconception that corporate income tax rate is 25%, but this is not actually true, because if we take the tax payable and divide it by net dividends, which are actually receivable, then you receive 25%. But normally the corporate income tax should be paid from gross dividends. So in this case, you have to take this amount, all the amount together, so the gross dividends in this case would be 125, and calculate out of it this 20% tax. So, and this makes this 25,000 euros. So therefore the correct tax rate is not 25%, it's 20%. Yes, so this is very important, because sometimes it's kind of mistakenly considered that Latvian corporate income tax is 25%, but this is not true. So to summarize, you can see that you pay just corporate income tax out of the dividends. In reality distributed, and then if you have this operating profit to 200,000 less dividends paid, less tax paid, then the retained earnings in this case is 75,000 euros. So this is also indicated here in a profit and loss statement. So this is the opportunity for each investor to save on tax for temporary purposes, of course, because at the end of the time you have to pay this tax sooner or later when you decide to leave the business. But of course, the time value of the corporate income tax saved is very important and very kind of considerable. So this is how the tax works. Let's move forward. And there's another nice thing about Latvian corporate income tax. It's a so-called flow-through dividends. So what does it mean? Also based on specific example, I will try to explain. So we in this example we have operating company. An operating company pays the same amount of dividends, 100,000 euros, pays corporate income tax here in Latvia 25%, and then holding company receives 100,000 euros. And when this holding company decides to redistribute those profits further on, so the same 100,000 euros which is received from the operating company, then at this point no tax is payable. So these are so-called flow-through dividends, and the concept is that the corporate income tax is payable only once. So this means that if it's paid at the operating company level, you are not required to pay it on a holding company level anymore. And ultimate holding company, which in this case is, for example, Germany, receives this 100,000 dividends without any additional tax in Latvia. So you can pay this tax only once. Yes, this is the another nice option, a nice thing that gives an opportunity to the Latvian company to be used effectively as a holding company, because these dividends received then could be redistributed, repatriated, or invested somewhere else in some other company, so without any additional taxation. Yes. So let's go further to the more practical case about investing in Latvian company, and let's see what are the options for the investor. For example, if we have a foreign investor, in this case a foreign individual, a physical person who wants to open a Latvian company. So basically there are two basic options. Yeah, the one option is to invest as a foreign investor. So without by saying foreign, I mean the tax residency here. Yes, like that has in this case the foreign investor is a person who has a tax residency in other country. So the other option is to become a Latvian tax resident. Yes, and then there are several opportunities and advantages for that. And the third option is to actually, as the kind of more related to first option, is to have the same to maintain the same foreign tax residence, but to use a Latvian holding company to get some benefits from this structure. And speaking about tax residence, it is quite simple to get Latvian tax residence. First of all, and this is the same actually as in other countries, because tax authorities are always kind of happy if you join the tax residence in that country and start paying taxes, but they are not very happy when you are leaving and giving up the tax residence. And that's why getting the tax residence in Latvia is quite straightforward. You are considered to be a resident if you just declare the permanent residence in Latvia, or you spend more than 183 days per 12 months period. So, but if you decide to move to Latvia and get rid of foreign residents, for example, in Germany or some other country, then you will have the challenge to getting rid of the old tax residents, because most of the tax authorities are very reluctant to seeing to letting you go from this from the respective country. So that's why in this case there might be a conflict between the residences, and then you have to use the double tax treaty to decide in which country you are resident. Yes, and usually the criteria for residency is the vital place of living, yes, place of residence, where you have family, you have job, you have a real estate, and so on. So what does it mean? It means that if you decide that to become Latvian tax residents, most likely you will have to have here some, I don't know, real estate, and to move together with family and get get rid of residence factors in the old country. So, but anyway, there are two options, and let's see the first option. First one, if that you invest as being a foreign, having a foreign tax residence. So yeah, in this example, we can compare two situations. One is that Latvian individual is having this investment in Latvia. So in case you change the tax residence in Latvia, you are individual which is considered to be in Latvia. And the second example is that you have the residence, the investor has the residence in Germany. Yes, and the difference is at the operating company level, there's actually no difference, because when you distribute the dividends, you should pay those 20% tax. Yes, in both cases, but the difference could be the difference at the level of the individual, of the physical person, is as follows. Yes, that first of all, individual which receives those 100,000 euros, which is not a resident in Latvia, he is exempt from dividends tax. So there is no tax paid here, but the not a good thing is that starting from this year, the income exceeding 200,000 euros per year for resident is subject to additional 3% taxes. So this means that until 200,000 euros dividends, individual with tax residence in Latvia do not pay additional tax on top of those corporate income tax paid already. Yes, but if this amount is exceeded, then 3% tax is in addition applied. So this is a certain benefit for a tax resident, because if we compare this the foreign tax resident, then of course from Latvian perspective, no dividend tax is payable here. Yes, and then for example, when German tax resident receives this 100,000 euros as dividends, he's not subject to any dividend tax in Latvia, but he most likely will be subject to tax in Germany. And usually dividend tax is usual rate is around 10%. So this means that if the German tax resident invests in Latvia and receives dividends, he will have to pay those 20% here. 25,000 euros in this case, and then probably will have to pay also 10% out of the dividends received. So if we compare here in Latvia with Latvian individuals, so up to those 200,000 euros, the only tax expense will be those 25,000 euros. Yes. In this case, if dividends are 100,000, then this 3% interest rate will not tax rate will not apply. So most likely, yes, this option is much more beneficial compared to if the investment is made by the directly by the German tax resident. So yes, this is comparison of the those structures, basic structures, when then individual decides to open a company in Latvia. So you can choose which of those patterns are more beneficial for you. Of course, I'm not kind of advising to specifically change the tax residence, but of course, if you are deciding to move to Latvia to change the country, let's say, then of course becoming Latvian tax resident will be kind of additional advantage. Yes. Yes. So next option is that more relates to individual which has tax residence in other country. So in order to kind of avoid this, not avoid, but to reinvest the dividends received without paying this potential 10% or other dividend tax in home country, then it makes sense for this individual to establish a holding company in Latvia. Yes, which in turn will hold shares into operating companies in Latvia or probably somewhere else. So what is the benefit of this structure? The benefit, as we discussed before, the flow through dividends. The benefit is that the tax is payable only here, then operating company distributes dividends, and then at the level of the holding, this holding company, no tax is applied. So basically, this individual, after receiving the dividends in this holding company, can invest those dividends or just hold this cash in this company. So cash invest or hold in the holding company without paying additional dividend tax in his home country. So these are the advantages of this structure. But there is one rule, one restriction, or whatever, call it whatever you like it. But the point is that the holding company should have substance. Yes, because we have in Latvian Corporate Income Tax Act we have a rule which says basically that the structure couldn't be abused. Yes, and the structure shouldn't be artificial. And by artificial, what does it mean? Artificial structure? It means that the main reason behind the structure shouldn't be getting a tax benefit, tax advantage. So this means that the tax advantage should come along with some more important objective of this structure. So what this means? This means that you have to that this individual will have to have some arguments why this holding company has established. What is the reason for establishing? Yes, and the most likely reason is that the holding company established for managing the investments. So this means that most likely this investment should be several, like here several companies, not only one. The holding company must have a substance, have some office, some employees, or at least one employee, and make some holding company activities. So it shouldn't be just a shell company, and the main motive behind behind this structure shouldn't be this tax advantage. So there should be some another main reason for setting up this structure. And of course, most usually such holding company is created not just for holding the shares in one company, but usually several companies. It could be the reasons could be like streamlining the business, providing management services, and so on. Yes, so the main point is that this structure gives the opportunities for cash flow management and for time saving of tax effect, but you should always remember that it has to have some business substance. Okay. So, and continuing this point about the substance, here is an example how can you use this holding company. And first of all, to get this, to put this substance into the holding company, most likely the holding company should have to hold shares in several operating companies. In this example, 2 companies, and then the one thing how to use it is that operating company distributes the dividends, pays corporate income tax, and then this investment is these dividends are reinvested into the other operating company. But this is not the only way how to do it. The second, actually, there are many ways, but the main point is that this holding company gets cash, and then this as dividends, and then yes, you can distribute as an operating company, but the other point is that the holding company can get this cash out of the operating company also in other ways, like by issuing a loan, providing management services, and providing license, like franchise, for example, and all these expenses for operating company wouldn't be taxed in a holding company, because here are the main principle of the corporate income tax, that the tax is payable only when then the profit is distributed here. But until this happens, then no tax is payable. But this cash generated from those operations could be also reinvested into the operating company, and in the form of equity or a loan. Of course, here you should also remember always that investment in loan has certain restrictions, but about that we will talk about other video. But currently, what you should remember is that there is such an opportunity that you can actually holding company can usually provide loan to its subsidiary without much problems. Yes, but usually problem starts when the holding company provides loan here to the parent company, because loan alone is could be considered as a hidden profit distribution. That's why if you decide to make a loan to the shareholder, then always remember that this should be checked, and then usually the loans could be issued for up to 12 months, not more, because when exceeding 12 months, then it's considered as a hidden dividends. So yes, basically here the structure, everything is quite simple, but there are many instruments you can play around, like these loans, management fee, royalty. The main point is here, just also say another time, that the main point is that this structure shouldn't be artificial, and it should be kind of substance in it. So this is a basic pattern how the holding company, how the Latvian structure could be operating from the tax perspective. And the next point is that which becomes more and more frequently used, is that in case if you have several shareholders in the operating company, then in addition to the considerations here, you have may have additional challenges, because multiple investors, usually means that investors should make some agreement between themselves. Investors can change their minds, their plans, and that's why someone may want to step out of the business, someone may consider to sell its part of the business, and so on. So in order to deal with all those possible situations which couldn't be kind of obvious at the beginning of the business, but which could develop in some over the years, there is a good idea to set up so-called intermediate holding company for each of the investors. Yes, so in this case, example, you can see that each operating company is not owned directly by the individuals, but each individual has its own holding company, and each individual can operate, can do this holding company whatever he or she likes. So, for example, one individual may want to continue business. Instead, individual 3 may decide to step out of the business, and then it will be much easier for this individual 3, for example, to sell the operating company at the level of the holding company. Yes, and then receive proceeds from the sale. Yes, and then to invest these proceeds to some other business, for example, and thus stepping out of this business, he can use this holding company to use the cash received from the sale of business in order to invest somewhere else. Yes, and this is, of course, this is one of the examples what may happen in real life, and it's in this case is much easier to do that if compared with the situation then the individuals would own the companies themselves. Then this would mean that for example that direct ownership the sale of direct ownership is subject to taxes, subject to personal income tax and capital gains tax. So in this case, this could be effectively managed. Of course, there could be also a situation that, for example, that the dividends are distributed equally, of course, between the shareholders in proportion to their shares. But one of the individuals, for example, may decide to distribute. They can spend the cash, other can decide to invest somewhere else. So thus this holding company, interim holding companies for each of the shareholders are a good instrument how to help the shareholders to acquire their own goals. Provided that those goals usually are not equal for everyone. So this is a good solution to handle different aims, different goals, and probably some also problems which may arise over the years of the running business together. Okay, this is another point which is interesting and quite oftenly used in practice. And the last thing which I would like to talk about is that of course that each business sooner or later is kind of coming to the end, and that's why in this respect Latvian corporate income tax also has some good advantages, and the advantage is that if this holding company sells shares in the operating company, and provided that these shares has been held for more than 3 years, then the sales proceeds, the capital gain of the sales could be distributed to the holding company, to the shareholders, without paying any additional tax. So this is kind of incentive that which stimulates to hold shares for more than 3 years. So this is a good thing, that provided that you have, imagine that you have a German company which has shareholding in Latvian intermediary holding, and this intermediary holding sells shares in operating company. Then for example, sales price is I don't know, 1 million, and the kind of purchase price or price of establishment company was, for example, 100,000 euros, then there is a 0.9 million capital gain arising. Yes, so sales price less purchase price, let's say. Yes, so and this capital gain could be freely distributed here without paying any additional tax. So that's a clear benefit. But there is one restriction that if the shareholder is an individual, then unfortunately this individual has to pay 20% tax out of this capital gain distributed as dividends. So this is from that one hand, the law gives opportunity to exempt this capital gains from taxation, but from the other hand, it moves this taxation to the individual level. So yes, that's not very kind of fair, but it is how it is, and what we should remember is that for a company, if the shareholder is a company, then for this company it's more beneficial to sell Latvian business compared to the individual. Okay, this was what I wanted to tell you about how to create a tax-effective corporate income structure, corporate structure in Latvia. If you have some questions, please do not hesitate to contact us. We will be happy to help you. So, goodbye.